Welcome back to In Plain Sight, a Trading Hub podcast in which we discuss the latest enforcement actions from regulators around the globe and the most pressing topics impacting the surveillance industry. In the last episode of this three-part series, we discussed the CFTC case against Total Energies for attempting to manipulate the market for EBOB-linked futures contracts in order to benefit their derivative positions. In today's episode, we'll be exploring another commodities enforcement action, this time against Macquarie Bank, also coming from Australia. So I will hand it over to Shane to lead us through this case. Shane, over to you.
Yeah, thank you, Andrew. Good to see you both again for part two. So I'm going to talk today a little bit about the Macquarie case where the ASIC, the MDP panel at ASIC enforced against them earlier this year. And I think perhaps before diving right into that, I thought I might give a little bit of background into the market in question. So this was an enforcement specifically in electricity futures. And I think it's useful just to think about that market for a second and why it's a little bit different from some of the other commodities perhaps we're more familiar with. So if I just start with, if we think about how electricity is produced. So you have, I think everyone knows and can picture a power plant in their mind. And the purpose of this power plant is to,
You're
of course,
supposed to reference the Simpsons there, Shane.
Oh, yeah, that's right. Yeah, Homer Simpson. He worked in
that's how we know what a
crucial
power plant
job
looks like.
at a power plant, right? So
Exactly.
Exactly. So whilst Homer Simpson is sitting there hovering over a red button, there is actual power generation happening. And the purpose of a power plant is to, burn fuel or, have your wind turbines running. And the purpose of it is to spin a turbine that will, through a generator, create an electrical current that gets pushed into a wire. Now, I'm glossing over a lot of physics there, but that's essentially what happens. And once that power is created, it's transmitted through the grid to suppliers. So that's like the wholesale part of the market. And suppliers will then transmit that, via substations to consumers. That's the retail part of the market. And really, so far everything I've described sounds a lot like any other commodity. There is production, there is getting it from producers to consumers, and then there is consumption. But what I think is a little bit different about electricity markets, and probably something all of us know but perhaps forgot, because I'm sure we all learned this in high school, is that electricity can't be stored, right? So it's actually a real-time production, real-time consumption problem, which means that this introduces some idiosyncrasies with this market where you can't stockpile it. If consumption goes up, you have to ramp up your production capabilities. And I think what it means is getting it wrong, where this balance of supply and demand has to be perfectly equal at all times. It's very expensive, actually, and there's a big cost to it if you mismatch your supply and your demand. And Mike, sorry, it looked like you were about to jump in there.
I was enjoying the introduction. I mean, it's it's really three distinct markets, isn't it? And I always kind of struggle a little bit with power markets because of that. I mean, there's the market which every single person listening to this podcast, or five of them, will be very familiar, which is the market when you go and choose your electricity provider. And really that kind of retail market, that is completely separate from the market we're talking about. But the market we're talking about, there's actually two components, isn't there? There is the real-time balancing of the grid. You're right, like at all times, supply and demand are mathematically equal. And what that means is if there's not enough power being pushed into the grid for the amount of appliances and factories that are on and things, then the voltage will drop, and that actually causes problems. Yeah. And so you have these kind of 5-minute auctions, don't you, where the operator of the grid is making sure that power is coming online or being instructed to go offline in pretty much real time, monitoring the balance of the grid. But then you have most of the hedging activity occurring in like the day ahead market, where the suppliers, the people who are contracted to provide electricity to retailers like you and I, retail customers like you and I, they are attempting to buy baseload and to make sure they've got the appropriate shape on top of it in order to roughly fulfill their expected demand, right? So they're not too exposed to what will ultimately get passed on to them for any imbalance, which is the dynamic cost that the grid operator is incurring by phoning up all of these kind of gas turbines and telling them to turn off and on, right?
No, exactly. And I think I think you mentioned an interesting point with the day-ahead market. So I think each country, let's think about, the US, the UK, Australia, just for argument's sake, they have these settlement windows where you are forecasting what your production and consumption will be in a particular window. And I think in the UK, I think it's half an hour. So the settlement window is a half an hour period. I think in Australia, it's actually 5 minutes. And if you get that forecast wrong, you're exactly right. The grid is balancing and phoning people up and saying, okay, you need to dial up production, you need to dial down production. And it's kind of, there's this price discovery process where there are meters on either side. And if what you actually consume and produce will be measured against your forecast, and the differential, there's payment that happens, right? Like you have to, money flows back and forth. So it's an incredibly active market.
It's complicated. It's even more complicated than that too, isn't it? Because there is depending upon the thickness of the copper cable and the voltage of the copper, the voltage of the wires, there is a maximum. There's a finite amount of electricity that you can push across any kind of high voltage wire, and so there's also the grid operator is also trying to make sure that the power is arriving in the right place. So if all of the consumption just randomly in Australia happens to be occurring in New South Wales, which would be weird, right? But let's say that was happening, but all of the contracted supply was being pushed in Tasmania or something. Well, there's just not capacity to get the power from one to the other, and if they didn't address that situation, they would burn out a wire, and they would destroy part of the grid infrastructure. So they have to then immediately phone up the power stations in this example in Tasmania and say either stop producing, or in some cases actually they can phone an industrial, cement manufacturer or something and tell them you need to turn a power station, to turn your factory on to consume some of this excess power in Tasmania, and then they need to think about the inverse problem in New South Wales.
And you get paid for that, right? So this is I've read situations where like a national grocer would be called up and be asked to turn their refrigerators like up or down a degree, and that has a significant impact, right? And and I think you guys in the UK have this problem like at halftime for like important football matches, right? Everyone's running to the kitchen.
That's soccer for our international listeners.
It creates this load on the grid, right? Everyone turning their kettles on like 1 minute after the whistle blows for half time, the time it takes to walk from the sofa to the kitchen. But I think this is maybe a good point for me to talk a little bit about this production problem, right? So electricity is measured and produced in megawatt hours. So I think, you could be forgiven for thinking a megawatt hour is a rate, like miles per hour or kilometers per hour, but actually it's not. It's a volume. It's kind of like an amount of electricity. And actually, so Australia produces about 300 million megawatt hours per year. It's about 3 terawatt hours, or 300 terawatt hours. Sorry. The UK is about the same, 300 million. The US, 4.1 billion megawatt hours. So a big difference.
So that's just going to do the maths. That's 41 times as much as the UK. Is that right?
That is. No, it's just about the UK was 300
million to 4 billion. Yeah, 13 or 14 times, right?
Yeah, that's a lot.
So they don't have 14 times the population of the UK. So I guess this is more air conditioning, bigger houses, better air conditioning,
bigger fridges,
bigger TVs.
But
it's much warmer in the US than it is here.
But to contextualize like what 1 megawatt hour is, which is oftentimes the underlying contract value for a futures contract. And I know Brits like double-decker buses, so I actually looked, how many in double-decker bus terms. So an electrical double-decker bus on 1 megawatt hour will travel 1,000 miles.
That's pretty good.
Which is pretty. Well, I was a bit surprised by that actually. I thought it was a bit low.
So if all of Australia stopped consuming electricity privately and just focused on moving one double-decker bus, they could move it by 300 billion miles.
300 billion miles. Yeah, 300
Yeah, it was pretty
million
good,
times
right? I
1,000.
mean, that must
Yeah,
get
yeah.
it to the sun or something, right? We should do that.
But just to round that out, it'll run a fridge for 3 years.
Okay.
A UK-sized fridge, not an American-sized fridge. Probably a bit less. For 2.5 years, if it's an American-sized fridge.
So far, Shane, you've been talking about the fantastic complexity of or we all have the fantastic complexity of the physical market, and the fact that it is as complicated as the problem, really, right? The problem's complicated. You are trying to provide a fixed voltage to 10 million homes or whatever there is in Australia, despite the fact that you have a series of like energy producing infrastructure, which is in different places and is producing energy at different times of the day. And, the market is going to take care of that in somehow. But having looked at this case, this is to do with manipulation of stuff in a market which is designed to be more straightforward and easy to understand, right? Like the futures market. So how does the futures market map on top of this physical market?
Sure. So two questions. So Australia, I mean, just to remind ourselves, we've established from a volume perspective in terms of electricity production, much smaller than, more mature markets like the US. So most electricity futures in Australia, well, not all of them actually trade on the ASIC. There are about 80 contracts that are out there, so futures and options on futures. Looking at, detailed, publicly available information, it seems like the ratio between energy production in Australia versus energy traded via this derivatives market is around 6 times. So, 300 million megawatt hours, about 1.8 billion megawatt hours in volume traded via derivatives. Now, just to contextualize that, to compare that to the US, so just one specific region in the US, so PJM.
I think what everyone wants to know is how far would that move a bus?
Maybe producer Siobhan, I don't know if you can do that quick math, given what I just said, and we'll come back to that. But PJM, so which is the Pennsylvania, New Jersey, Maryland regional network in the States, which serves about 65 million people, which is about double the population of Australia. Just that market alone produces 780 million megawatt hours per year, and the derivative value is about 10 times that. So Australia is not a very, medium liquidity, I'd say, on a global scale. It's isolated. You can't transfer. Australia's it's a continent, but it's an island. You can't send electricity across borders. And also it can be very volatile, just given the conditions out there.
But these actual futures contracts, my understanding is, so I think most of the liquidity's in a contract which is really, really producing quarterly baseload. So it is a contract essentially trying to ape the return on or the payment for providing 1 megawatt non-stop for 3 months. So this will trade at a certain price, and ultimately it will cash settle, and the cash settlement will be equal to the average price over all of the 5-minute windows.
Over the whole quarter.
So very important, right? It's from the spot market, not from the day-ahead market or anything like that. It's from the spot market. It's going to average the 5-minute price over the entire quarter, and then, in fact, it's going to add it up, because it's like, it's going to average it and then multiply it by the number of hours in the quarter. So there's like 2,000 or so hours every 3 months. I think that's right. So you're going to take 2,000 and you're going to multiply it by the average price per megawatt hour over the quarter. So it's got a sensitivity equivalent to about 2,000 megawatt hours of energy, right?
You're saying that's the highest.
That's the bet you're making. That's the bet you're making when you trade the future, right? You're basically, if you trade one futures contract at a certain price, let's say you buy that futures contract, you are betting that the average price of producing a megawatt over the quarter will be greater than the price that you entered into the futures contract by. And if you're right, you're going to make about $1, $2,000 for each $1 that you're right by.
Yeah. Would you say that is the energy market kind of a bit unique and a outlier in the commodities space? Because a little foreshadowing to episode 3, but say you're talking about, I don't know, wheat futures contracts in Australia. everything there is actually physically delivered. And a lot of the trading is actually done because you want to have, say if you're a large miller, you want to have like 2 months supply available to you at all times. And you're actually storing that. And, the storage process and then hedging that with the futures contract is like the main reason you're involved in the market. Obviously, there's no storage aspect here within the electricity market. So, I mean, it must kind of make trading strategies completely different, but is that kind of unique, or are the markets that are similar?
So I think it's actually very similar to what we were talking about last episode in
that's
isn't
what I was
it?
gonna say.
So we had that Chicago-based futures contract, but the final cash settlement of that will be equivalent to the average price over the period of a month. The average price delivered into some dock in Rotterdam or Amsterdam. Whereas I suppose with this baseload contract in Australia, it's equal to the average price paid for providing a megawatt over the period of a month. And that will be specific to a megawatt being fed into, presumably, the high voltage lines at a very specific point, right? One of the 5 kind of central points. I think Australia has 5 kind of main markets,
regions,
don't they, for regions where the electricity futures are trading with reference to. So I suppose it's providing a hedging instrument for baseload, right? Like, there's a certain kind of base requirement for the grids.
There's no peak. It's just like the base. Yeah.
And then on top of that, there's like a shape factor, isn't there? Like, people, there'll be a maximum point in the day. Presumably it's in the middle of the day in Australia in summer or something where it's hot, so everyone's got their AC on.
So is it? Oh, go ahead, Andrew.
Well, I was going to say we could talk megawatt hours all day. I know, but I think we haven't actually talked about the case at all. Maybe we should get into what the actual abuse charges were.
No, I think that's it's a good segue. I think it's important to contextualize. But why don't I summarize the facts of the case, right? So overnight, the content of the enforcement, which came out earlier this year, 2024, over 9 months in 2022. The allegation is that 3 commercial clients of Macquarie essentially used Macquarie's access to the market. So these were DMA clients, direct market access clients, to place what would then deem to be, at the end of it, deemed to be suspicious orders, so 50 in total suspicious orders, directly on the ASX. And they did this again over the course of 9 months, but in every case, all of these orders were placed extremely close to the close time. So 4:30 p.m. is when the trading day ends. And the intent could have been to manipulate the daily settlement price of the particular contract that was being traded. And I think it's worth highlighting a couple of things here that are interesting about this case. So ASIC ran what looks to be a very fulsome investigation. I've got a 22-page document here somewhere that outlines the details of the case, but just a few things to pull out. So this was the largest fine ever issued by the MDP from ASIC, $5 million, Australian dollars, which I think is about $3.5 million US dollars, 2.5 million pounds, something like that, depending. I don't know what the pound is doing these days. You guys have had
it's normally going down.
So I think the MDP makes some interesting statements, which I'm just going to read out here. So Macquarie, as an institution, is actually responsible for about 58% of the volume of these electricity markets. So ASIC is alleging that it plays a very significant role as a gatekeeper to these markets. So despite the fact that there are underlying clients using its pipe, given its profile, it plays a gatekeeper role. These 50 orders over these 9 months in 2022, it was during a period of extreme energy volatility. So prices were jumping around a lot. I think there was, certain things happening in Europe at the time that may have influenced global energy prices. The other thing it alleges is, of these 50 orders, a lot of them lacked kind of commercial reasoning. So they were buys and sells at prices that were not commercially reasonable. So again, indicating that the intent was probably not to trade at best price, but there's probably something else going on. And I think what's more interesting actually is over these 9 months, ASIC actually reached out to Macquarie, I think a total of 3 times, to kind of query this specific activity that was taking place, because they could see what was happening on the exchange, to say, look, I think, by the way, this looks kind of suspicious? Can you tell me if there's flagged an alert in your surveillance system? And I think in each case the answer was no, and we can delve into it a little bit.
And Andrew, question maybe for you, maybe it's unfair to ask you. I know in the US, many of the exchanges kind of outsource the monitoring of the trade flow on their venue to SROs, like NFA, for instance. Is that the same in Australia? I mean, is ASIC coming is ASIC coming to Macquarie here because they are the kind of conducting routinely on behalf of ASX the surveillance on the exchange, or are they coming because there's been a complaint, for instance?
That's a good question, and I don't know the answer, to be honest. I think because also, kind of reading through the case too, and Shane sharing some of his notes beforehand, my impression was it was kind of the ASX was also involved in some of the investigation, which would lead me to believe that they, kind of have their own, process, either by identifying, intaking complaints and investigating it, or monitoring the activity. I know, like, for instance, like the CME has put out in the commodities market kind of their own fines for violating exchange rules that have kind of sat alongside CFTC allegations. But then, as you said, there are kind of other venues where it's kind of, they're kind of delegating that to the SROs. The other interesting bit is ASIC isn't an SRO either, so they are obviously kind of entity of the Australian government. So I don't know if then that kind of would preclude them from running that on behalf, because then you lose a layer of oversight, right? So if like the SRO is monitoring for a venue, then you always have the CFTC and SEC kind of sitting as an oversight body looking over them. If ASIC were doing that on behalf of ASX, then who's kind of providing the oversight over ASIC?
Yeah.
So I might have answered my own question there with kind of logicking through it, but I guess a lot of times the ASX itself might actually be kind of seen as an SRO. There's a lot of kind of some jurisdictions where that's kind of they operate, where I think in like Japan, so JPX group, which kind of runs Tokyo and Osaka Exchange, they have a whole entity called JPX Regulation, which is essentially an SRO, and they run a lot of surveillance on all of Osaka, Tokyo markets, and then they will refer things to the SESC and the JFSA to actually bring enforcement proceedings. I think probably I won't think, unless there's kind of very different setup with Australian law, I don't think that ASIC would be able to kind of run that surveillance for
maybe our producers can have a look in the background while we continue.
Go on.
Yeah, that's an easy research topic.
What's interesting, I mean, maybe just to come back to the case for a second, I think one of the interesting things about this is to really think about why these orders are suspicious. I think because there are 50 orders in particular that have been called out, and in each case, ASIC mentions that the daily settlement price for the contract was affected, and they actually have a dollar estimate of what the impact was. I think it's worth just digging into that a little bit. So the way that the daily settlement price in this market is calculated is that in the closing minutes before the market closes for the day, so 4:30 is when it closes, it takes it takes the volume weighted average price of all trades that are executed in the final 2 minutes. Then it multiplies that by the number of trades that have taken place. And then it adds that to the volume weighted price of all the orders that existed in the final 10 seconds. And then it adds that to the number of the orders. And then it divides that by the total number of trades and orders.
And these are only orders where they are bids which are higher.
That's right. They have
the most recent trade or offers which are lower, right? So they're kind of frustrated trades in a way.
Yes. Yeah. And I think what's interesting is given that formula, and given it's very transparent as to what the window, you've got 2 minutes for trades, you've got 10 seconds for orders. I think in this particular case, I think there has been communication that's come to light that speaks to placing some of these trades and orders specifically within that window. So, I think there was one that, with 2 minutes to go or something like that. I mean, it's quite telling, isn't it? If you're instructing your broker to place a trade within
I saw that as well. I think they say, please place it with 2 seconds to go or something. Which
2 minutes, I think, something like that.
Yeah, but I mean, if you're really trying to move risk, that would be an odd request, right? You would say, actually, I'm trying to get something done. You'd like to show the market that price immediately or for as long as possible. It's odd to say that you'd only want it to be shown to the market with 2 seconds to go. So I think it's probably worth, because you were talking about daily settlement price, and I think earlier we were talking about cash settlement price, and these are very specific terms, aren't they? So earlier we were talking about how the spot market for electricity was used to determine the cash settlement price for the future. So we're really saying that at the end, eventually the future will expire. And there will be an exchange of money to, which will be the cash settlement, and it will be at the cash settlement price. And that exchange of money will essentially determine who won the bet. But that's not what you're talking about being manipulated here. You're talking about a future where it's not cash settling yet, right? So there's still time to go. Maybe this is a future for the delivery of electricity, which will start next quarter. And you're talking about people manipulating the close of that future. So why would they do that? What's the weeds? How do they get rich by doing that?
I think it's a great question, and you've really hit on something there. So I think I mentioned this was a time of significant energy volatility. And actually, ASIC is quite specific in making, again, as I say, dollar estimates of what the benefit was. And I think what your question is, well, where is that benefit crystallized, right? And I think they've specifically called out margin. So I think what's happening here is the allegation is that these 3 clients were trying to defend a level at which they may have to post additional margin given pre-existing positions. And I think go
on. And do you have an idea of like how much margin they were managing to save by the?
I do actually. So I think the estimates. I'm just going to flip. There's a very nice table which has been put together here. So I think the estimates range from as low as $15,000. This is on a specific order basis, all the way up to I think 4.2 million.
Okay, so I'm just trying to think. I mean, actually, what does that mean in terms of real lasting benefit? So if I've got a futures contract and I manipulate today's settlement price, I'm not going to receive or pay any money long term, but I'm going to enjoy the benefit of
one day
more margin than I should have had until we get to tomorrow's settlement price, right? So I think the biggest number you said was what, 4 million?
4.2. Yeah.
So 4.2 million Aussie dollars. I get to enjoy having that for a day, right? That doesn't feel like that's worth a lot. That feels like that's worth a few $100s or something. What's the overnight interest that you would get on $4.2 million? Why? I mean,
you must be the first person to tell me $4.2 million doesn't feel like a lot.
No, but you're only getting it for a day. Right? You have to give it back the next day when you get the natural settlement price again. So you've got 4.2 million, and it's Aussie dollars as well. It's not like, but it's only 2.5 million real dollars. But no, you get $4 million overnight.
For a day,
so if you wanted to go into the interbank market and borrow $4 million overnight, you would pay, 2 basis points or basis points. It's going to be something like that, isn't it? And that's like $600. So that's the actual value of $4 million overnight or something. It just doesn't feel like an awful lot. And even if they've done that 50 times and they got $4 million every time, you're still talking about not very large amounts of money. You're talking about $20,000, and it sounds like $4 million was the best result they had.
4 million. Well, it was, but that was the highest number. But I think it's interesting, isn't it? So I think we got to think about who the underlying client is here. Right? This isn't Macquarie Bank doing this. These are people behind, independent people who it may be harder for them to borrow. Maybe they don't have access to the interbank market, right? To bring up $4.2 million. I think these were 3, and it's quite telling that. And I've had this question in every case actually, that none of these clients are mentioned, and I'm a little bit uncertain as to why they are granted this kind of cloak of secrecy. I guess because Macquarie's the one regulated by ASIC, and perhaps there's criminal investigation happening behind the scenes that we don't know about. I mean, maybe Andrew, you can.
Yeah, that would be my guess. I mean, I guess, we don't know. So, I mean, either way, if they're kind of participating in the market, so they would still also be, under ASIC's jurisdiction. But as you said, if they have if they are like individuals, they're more likely to actually, they're not going to try and bring this to some market disciplinary panel. They're going to want to actually have their day in court and try and get out from under it. So there's a good chance that it could be still some criminal proceedings or something going on, and they don't want to necessarily kind of, I don't know, potentially prejudice themselves if they're naming them in an action separately to Macquarie. So,
the other thing, just to perhaps close on before we open this to a broader discussion, is the outcome of this enforcement isn't actually saying that this is manipulation and it's not penalizing Macquarie for manipulation. I think what the crux of it is that as a gatekeeper to the market, you had reasonable reason to be suspicious of these orders, and here's why you should have been suspicious, and therefore it's really a failure to supervise, which I guess doesn't preclude further criminal charges from being brought on the underlying clients later on down the line.
Yeah, I think that's a very kind of topical subject in the commodity space now, especially in Europe, with kind of Remit 2 coming into place and some of the obligation that come along with that. So, ostensibly what they've done is taken the requirements that are within MAR around filing stores for, when you identify potentially manipulative activity or insider trading, and have applied that to, wholesale energy markets. So that, means you need to have reasonable, process, procedures, controls in place to actually identify the manipulation, insider trading, and then file those stores. Obviously, in kind of what ASIC is charging here, that was where the failure for Macquarie. But I think even we've had some discussions with people within industry that this remit requirement is something that's going to bring out quite a change, and they anticipate very kind of strict requirements. Even if you were a bank offering DMA, how closely are you monitoring that activity? If you're a commodity trading house, how closely are you monitoring your activity, especially in the energy markets, to make sure that you are meeting that obligation to report any potential market abuse that you're able to identify. So I think it's very kind of a timely, definitely something that's kind of people in kind of the commodities industry are looking at right now.
Is it worth just exploring the similarities and differences between this and the Totsa case? So Totsa, we had someone who was actually having to sell an awful lot of physical EBOB, 60% of the volume of something, so quite, thousands of tons a day, in over a period of a month, so that they could cash settle their futures bets at the wrong price. That's the essential facts that the CFTC allege, right? Whereas in this case, the physical market, I think, is unaffected, right? So no one is suggesting that by trading these futures contracts that the wholesale price of electricity was affected. Obviously, this is a hedging instrument, so I suppose you could make an indirect argument that this would feed through.
Although, I mean, if you
it caused no lasting permanent settlement of any trades at the wrong price. It caused things to be mismargins incidentally. I'm not suggesting it's not manipulative, but I'm just asking in terms of, if we take both of these allegations at face, one of them seems a more substantial kind of artifice than the other.
I don't know if ASIC would necessarily agree with your assertions, Mike, because I think they had some quotes in there. One of kind of jumped out to me is like, they mentioned the consequence of manipulating energy markets can have detrimental flow.
Other people being margined.
Yes,
right?
Supplier funding costs. That's then in turn impacts energy prices, and that leads to higher energy bills. And I mentioned, cost of living crisis and things like that. So
yeah,
I mean, maybe it isn't, directly touching the cash,
it is more
but
indirect, though, isn't it? Like, I'm not suggesting it's not manipulative, and I'm not suggesting that they shouldn't be enforced against. I think I'm just pointing out the scale. Like, if let's take both of these enforcements at face value and say that all of the facts are correct. One of them involved selling like an entire month's worth of gasoline for Europe, pretty much at the wrong price, and the other one involved kind of putting in a few bogus, unexecuted orders into a futures close to avoid some overnight funding. They just don't seem quite the same scale to me. But I might be missing the the knock-on impact to the Australian consumer by the circuitous route.
Well, there was quite a difference in fine amounts, right? Because I think what Tatsa was 48 million and this was 4.
Regulator, no? I mean, look, we should remember that.
True.
I mean, I think if you think about the motivation, I mean, look, so I think the other thing ASIC alleges here, which they were very upset with, is
Actually, you know what? Actually, I think. Sorry, I'm interrupting you, Shane, but I think I'm going to answer my own question. I mean, isn't a big part of it that the allegation against Totsa is that Totsa would doing this to enrich themselves? The allegation against Macquarie is that they were not doing a sufficient job of surveilling their customer flow. Right? So no one is suggesting that Macquarie was going out there and deliberately kind of trying to manipulate energy markets. Right? It's more the case that it's a strict liability finding against them, isn't it? That they failed to reasonably supervise their customers. And I think the statement says that the brokerage that they got out of this, for instance, was de minimis. They weren't doing it for any financial gain, Macquarie, right? It was that they weren't operating a reasonably designed surveillance system, much as anything else is.
Yeah. I was going to say that the other thing ASIC alleges is that this activity pushes people away from, a safe exchange where there's clarity around everything to the over-the-counter market. So it's like a kind of sanctity of market thing as well that they were a bit, upset about.
Yeah, I mean, if you corrupt the price signal, that's always harmful. 100%. I 100% agree with that.
Yeah.
So one thing you haven't touched on, Shane, I suppose, and I'm definitely not suggesting that we have any uncharitable discussions about the surveillance technology employed in this case, but there were the case will speak to the challenges of surveillance, right? So it wasn't that Macquarie wasn't operating a surveillance vendor. I mean, I think they were using a well-regarded one. I'm sure that they were trying their best to make sure that surveillance technology was set correctly. But if you read through the ASIC finding, they talk a lot, don't they, about they spend many pages, in fact, detailing the correspondence between Macquarie and their surveillance vendor around the kind of dominating the close scenario that should have picked this up.
Yeah, it's quite painful reading, actually, when it goes on for a number of pages. I think you're exactly right. So in this particular circumstance, I mentioned earlier on that ASIC reached out, I think, 3 times. And after the first time they reached out over this 9-month period, Macquarie did go to their surveillance vendor and kind of ask, why didn't this flag? And what transpires over kind of 10 pages or so, maybe a little bit less, is excerpts of email exchanges between individuals at Macquarie and individuals at the support desk of the surveillance vendor trying to, widen this flag. Oh, everything's operating as normal. Is something wrong? We're still investigating it. We'll get back to you in a number of weeks, until finally, I think kind of 7 or 8 months in, someone said, look, this is a serious problem, and we've got the regulator asking us, we need an answer now. And it was kind of answered immediately, and what it was so what you mentioned, market dominance at close. I think the close part of that, the name of that control, is very important. I think what happened here was the close of the market, as we mentioned a couple of times, is 4:30, and I think there was a misconfiguration that was hard coded that had to close at 4, which just meant that you would never going to identify these cases if you're only just narrowly looking at essentially the close of the wrong window. So that's kind of what happened here, and it's described in significant detail in the enforcement. Again, quite painful reading.
Yeah, I mean, so I think this speaks, I suppose, to some of the reasons why surveillance can be quite tricky. So in this circumstance, it looks like this isn't like the recent OCC fine, for instance. This isn't about a data set that should have been monitored, which wasn't. This is, the surveillance system was set up correctly. The trade flow was correctly feeding into it. The correct scenarios had been set. The compliance officers were presumably diligently looking at the scenarios, but there was a dependency on a piece. And any surveillance vendor, this isn't a partisan point, I think could have this problem, couldn't they? There's a dependency on a piece of reference data for that scenario to work effectively, and that reference data, as you said, was the close time for the particular contract, and that was miscalibrated, and it speaks, I suppose, to the essential kind of work of governance that needs to happen alongside these controls, right? You can't afford to take at face value that these things will be correct.
Yeah. I think there is. I mean, and also there is a little bit of a trend for, we're seeing people talk about back runs, right? Which is where you realize that something was set perhaps incorrectly, and there's a huge burden on going back to ensure that you're rerunning things correctly, and rerunning your analytics with the correct kind of parameterization. So kind of ongoing.
I was saying this one too. They mentioned it wasn't specific just to the ASX as well. I think there were two other markets that this hard coding issue impacted. So, if knock-on effect, as you said, now they need to go back through that, I don't know, whatever that time period where that hard coding error was in place on all those other markets, rerun
a long time.
all of this marking the close alerting, and then kind of cross their fingers that they didn't actually have anything that looked like market manipulation in those other markets. Otherwise, they're filing very late stores and kind of hoping that I think one of them was NYMEX, maybe, or U.S. markets, and hoping that the U.S. regulators take a lenient view, which I don't think they would. So
I think it was 4 years. So January 2018 to 2022, and it was, you're right, intraday options on bond futures, overnight options on 10 and 3 Treasury bond futures, some New Zealand market. There was a number of markets actually that it was impacted by, and I think bottom line, this, it's a failure to supervise. These were suspicious, and you should have known.
So I guess the question then is, how close was the Total Energies had to pay $48 million, but Macquarie had to kind of run a 4-year look back across however many markets involving however many consultants and hiring extra people to do that. Maybe they're not actually even manipulating the market.
Not so far apart after all.
And then the final dollar amounts, I think, if you were to kind of add them up, maybe not that far off.
Any other questions on this case?
One for me, I had two, and I think this, kind of the same topic we're talking about around aggregating factors and what they kind of wanted to figure out the fine amount, which kind of jumped out to me too. This activity was kind of alerted to Macquarie, and they kind of start their investigation, but it seems like then they just kind of let the trading continue for a good 9-month period too.
That is true. So that is one of the things that ASIC said, where they said, look, we asked about this a couple of times, and the clients continued trading. Now, not of the 3 clients, they all didn't. It's interesting. They all weren't trading at the same time. They're a distinct period. So client 1 is involved for a period of time, then client 2, then client 3. But I think that the allegation is you should have kind of switched, taken a harder look at this.
It's odd, isn't it? Do you think there's something specific about these electricity contracts which would make 3 people independently have the same idea about this margin-based strategy, or do you think that this is indicative probably of a wider spread market practice, and it just so happens that ASIC have chosen to look at these order books?
Yeah. So I think
because and you mentioned it too. I mean, there's a lot of politics about energy prices, right?
there is. So I think if you look at, I mean, look, when you look at the formula for the daily settlement price, it is a formula that looks like you can actually, without low volume, like one contract, two contract, you can probably influence the daily settlement price. Like if you look some of these cases, if you look at the 50 orders in greater detail, some of it's like one contract. There's one, two, three contracts, and so I don't know if this market particularly lends itself well, just given the illiquidity we spoke about earlier on, the fact that the settlement price.
You think it's not quite got critical mass to automatically provide fair end of day prices?
I wonder. I mean, not to pass too much judgment on the Australian market, which I'm heading to Australia tonight actually, so I don't want to be
stopped
at the border or anything. Yeah. I'm about to land in 2 days. It takes a long time to get there from here. I leave on Thursday, I arrive on Saturday. But I think there is an element of this market being susceptible, shall we say, just given the way the daily settlement price is calculated. I think this is more widespread?
Well, again, good foreshadowing into make sure everyone tunes into our next episode where this may be something that comes up. But I wonder if it's not necessarily specific to energy markets, but maybe to the ASX, because it does. I mean, I could say, with certainty for at least one other, futures contract market that's traded on the ASX, it has a very similar daily settlement price calculation mechanism, which is kind of easily manipulated, where you can just put in, single lot
right?
bids that don't even get filled to kind of move the settlement price, and then everything's marked to market against that settlement price. So I guess this kind of more, speculative corner, but that kind of raises, just when you're mentioning that, Mike, too, it's like, what are the chances that these are kind of three completely independent parties doing the exact same thing in a 9-month period through the same BMA bank? I mean, that to me seems, low probability.
It is a conspiracy.
Yeah.
Oh, wow.
Heard it here first.
Say it's a true crime podcast.
Yeah.
Well, it seems kind of strange otherwise that you would have this kind of unless it is just kind of like that's just common practice in the market. It's like, oh yeah, here's how you kind of avoid margin calls. You just kind of bounce around the daily settlement price.
So I suppose if you were the kind of person who really cared, was like day trader, kind of really cared about margin calls rather than I always imagine if you've got a bigger balance sheet, this is maybe less of a concern.
Yeah.
Because as we've discussed, it's the cost of overnight funding. Whereas if you're a day trader, maybe it's the difference between kind of forced exit from a position or not. I wonder if there's something particular about energy markets in Australia which attracted a lot of that kind of participant. I mean, they were presumably quite interesting markets because energy was volatile.
Yeah.
They're not physically settled, right? So, I mean, if you're a day trader, the worst thing that could possibly happen would be to be expected to, I'm on the hook now to actually deliver some electricity to the grid, right? That would be bad news.
Yeah, that would be bad news. Yeah.
So maybe there are other markets where day traders stay away from. I don't
check
know.
Check the Reddit boards.
But let's put your money where your mouth is, then, Andrew. So you think this is indicative of a broader conspiracy? That must increase the likelihood that ASIC actually follows up with enforcement against the ultimate owners of those orders. So would you like to give us some kind of forecast of the likelihood of that happening?
Wow. Yeah. I agree. It definitely would.
And for the tape, Andrew did go to law school, so he is qualified.
Yeah,
I know.
The tape. It's all on the tape, Shane, right?
I asked him to put some, diploma or something up behind me, but it was my request is denied. But I feel like, I mean, if there was some sort of, cartel collusion going on, then it definitely would be some.
We've gone through conspiracy to talk.
Well, they're kind of the same, one and the same, really.
Do you think the Illuminati might be behind all of this, Andrew?
Andrew's conspiracy corner. Yeah. That's our new segment that we're going to be introducing soon. But I have some interesting views on the JFK assassination. But that case is a lot harder to build would take a lot more time, so would lead to it. Although there have been kind of similar margin, avoidance, let's call them manipulation cases, where it was, first a market safeguarding fine brought, and then the ultimate, a person who was kind of trying to manipulate the market had charges brought against them by ASIC, and that's kind of moved a bit quicker. So, yeah, kind of hedging my bet, but I would be kind of maybe surprised to see later on down the road 3 individual charges come out, but maybe one kind of larger case against 3 people working in concert, but taking a bit longer to come out would kind of make sense to me. But yeah, still, I don't know, 50-50.
Before that, you're taking us through a similar case next time, right, Andrew?
Yes.
Yeah.
So that's kind of informed my my bet a little bit here on this market.
Do you think it was the same guys behind both cases, Andrew?
Well, you have to wait for Andrew's conspiracy corner in the next episode to find out.
Yeah.
But yeah, this is a really interesting talk on the Macquarie case. But I think that's all the time we have for today, unfortunately. But thank you, everyone, for joining us. In the next episode, which I think we've kind of properly foreshadowed during this one, we will be discussing another ASIC case against JP Morgan, also in the commodities market. So look forward to speaking to everyone then. Thank you.
Thank you.